Right. Good morning, good afternoon, and good evening to all of you who join us today. Thank you for joining me and Jonathan Shelon, who is my colleague, also who is a person that I've known for decades, probably decades now. And many of you have known Jonathan as, his paper, as China is the asset class is well regarded, well received by all of you. So thank you for those feedbacks, and also many of our products and other opportunities when we're sharing our insights on how to size your allocations in China in your global portfolio is widely shared with you from Jonathan in terms of article, webinar. So I'm very, very honored to be joined by Jonathan today. Before we kick off today's session, I have a few housekeeping items that I need to share with you before we begin. So first and foremost, we really want a very interactive conversation. We are here to answer your question. We are here to address anything you have concerned about the market or need an answer for anything. So please submit your question to us, either through, whatever the way you dial in today's webinar. If you're really streaming out on our website, feel free to send your questions directly to us at info@craneshares.com. And if you are in Zoom today, you can send in the questions through the Q&A button in your screen now. So we're also offering the CIMA, CFP, and CPD credits as the continuing education credits. So if you want those CE credit, please email us separately at ce@craneshares.com. So that's my housekeeping item. So today's session, really, Jonathan and I want to give you a bit of a deep dive to review what has happened in Q1 in China. What is the macro condition? What is the updates in terms of policy? Even investor sentiments. I was having the great pleasure to go back to China physically in 40 months. First time back to China, 40 months, witness a lot of things there happening in China onshore myself. So I have a lot to share on my trip, what I've seen, what I've observed. So I will share all of that experience with you. We'll give you a bit of market update, and Jonathan will help you to dive in on the questions on allocations into China, into your portfolio, and catalysts we have been observing, and what we potentially see that could be interesting developments happening in China. So onto the presentation. If let me go to the next page, I sincerely hope many of you who join us today are our long-term investors. If you are new to our firm, I'd like to share a few things that CraneShares founded about 11 years ago now. We really started with us focusing on China, solely focused on China. Over the years, we have developed, evolved, and built and grown upon to today. We have 3 pillars of strategy that we offer to help clients to diversify their clients or their overall investment exposure. China, and also other themes that led by China or need China's big contribution, such as smart EV ecosystems, such as carbon, climate, green technology, green solutions, so on and so forth. And then third pillars is our uncorrelated, more of a alternative investments suites. Onto the next page, you will see our ETF suites. These are the products available in our US business. These are all public listed ETF. SEC approved ETFs. There are 30, I think give or take 30 ETFs available in the US suites. The next page is our UCITS funds that is listed, registered locally here in Europe. Obviously, all these funds are available in the local currency, namely dollar, euro, and sterling. And it's listed in Milan, in London Stock Exchange. Some are also available on Amsterdam Exchange, and also all of them are available on German Exchange. If you move on to the next page, I really want to start looking at the quarter. Obviously, if you just look at one quarter return, you probably feel, oh, okay, this is another quarter that, the asset class hasn't really, outperformed the broader asset class. But it's very important for us, all of us, to understand what has happened during the quarter from top down and bottom up. What is happening? What is triggering? What is prepared for us to look at this asset class going forward? So number is the number, but to be fair, from a late January's correction, that the asset class, particularly the high beta, high growth stories in China, actually has caught up massively in terms of performance and returns. I leave those statistics number to you to digest yourself. But if we go to the next page, this is where I want to start the conversation. Is really, for very long period of time that we have been stay connected with our partners onshore in China, and many times that we got a question from clients to say how we should look at this asset class. Is Chinese policymaker stay focused on growing the economy? Is Chinese policymaker really want to grow its capital market, so on and so forth? So we listed the charts here. This is also the next page, but this is the charts we want to show you how much policy has been announced and introduced by the Chinese policymaker from March last year until now. You do the counts, you do the math. In 2023 itself, from March until December, 9 months of period of time, give or take, taking the holidays out, 8 or 9 months period of time, Chinese policymaker announced 24 key major policies, touching physical expansion, touching issuing ultra long dated bonds, touching on the policy of easing, cutting risk, make liquidity really, really sufficient in the systems. This chart obviously is to show you where, from a senior leadership perspective in China, where they are standing, where they stay. And each of different months and period of time here shows different type of policy touching monetary, physical, regulator, and key events that are happening in China 2023 and 2024 thus far. If I may summarize all these things together with one word, is all of them are intended to pro-growth. Any message, key message you heard from all these statement release, from all these key events or key decision making, touching on monetary, touching on the new policy introduced in the events, it's all literally pro-growth. So I'm very pleased to see the consistency they have been introduced thus far. Now it's like 13, 14 months into this easing cycle. This is accommodative cycle. It's very consistent. It's very persistent. The top-down message is to help the economy to recover, help the economy to rebalance its new productive force. So that is quite encouraging to see. The following page, we have detailed all the events, all the key message happened throughout all the different period of time that I just mentioned, from March last year till all the way till now. If for those of you who wants to go through the list and knows which exactly the events is happened here, you feel free to do the referencing yourself. But all the key message you can see, it's a very busy agenda. All those areas that can touch, help, support the economy to grow is all announced, accommodated, and all these policy has been put in place. A lot of people saying, I didn't feel like, the kind of bazooka money coming in to China, but they have done very targeted measure, inch by inch, but very consistent in helping the market back on their own foot. At Crane Shares, the next page is we have maintained a whole list of things that we could check on China, and then what's the key things we watch, and also the key events that can impact or make us rethink or make us reevaluate the situation in China. This year in March, I have to say, the most important events happened this year, and events that get most spotlight for global investors to watch out that is happening in China is this 2-session meeting. It's called NPC, National People's Congress. What is usually happens here is who is attending, Xi Jinping included, Premier Li, and all the senior officials from China will be attending this session. Usually session starts with Premier Li give a work report of what has happened in China, what China has achieved and targeted last year, and what is the goal of economic goal of the next year in 2024. And then I'll give you all the key message, key takeaways, but I often get asked last year does President Xi Jinping really knows what is happening in China? I listened to Premier Li's speech in Chinese. It's 52 minutes and 20 seconds, 3 times. Okay, the reasons for me to doing that is I am really amazed how many times he has been so honest and telling the whole audience the challenge the economy face, the difficulties that the economy has been facing externally and domestically. Hence, their returns was such. What are the measures being put in place, and continuously, what are the challenges they're going to, what they anticipating going to happen this year? Hence, they set economic and so on and so forth. His big boss, President Xi Jinping, was in the audience. He's listening to all these work report by himself. He heard all the challenges being articulated there. Thousands of people attended. The senior official, senior leader team was there. So they alleged the claim that he doesn't know what is going on. I sincerely believe that's not quite a true statement. So that put aside, the senior leadership is completely acknowledging the challenge, number one. That's a good thing. You know that you face challenges. Second, continued commitment to put pro-growth policy, money available, and help the corporate to grow, help them to find a new direction, new productive force to grow their business. Is full commitment, full speed ahead. That's what I heard from the message. Third, set a realistic target to grow the economy. You don't want them to be unrealistic, putting things there, doesn't acknowledging what is happening. That is whole message I got from this MPC. We put the summary of the key takeaways of all the major economic targets indicators here. You can clearly see the aim for GDP around 5%. That will actually give them to achieve the goal of the urbanization and industrialization goal they set at the beginning of this 5-year plan. Okay, and obviously the inflation targets and employment. What else is quite important in these indicators? Two other things. One is the new employment or new jobs they're going to create, over 12 million people. That's new jobs they're going to create. So think about that. If that is a target, how much policy measure they need to put in place, how much they should help and encourage the corporate start hiring people, create jobs for these people is absolutely crucial on top of their agenda. The last point is the issuing of the ultra long dated bonds. Someone say, oh, it's only 1 trillion RMB. But the statement from Premier Li was very clear. This is to start with. So I have a very strong, belief. This is really them to say, this is actually is unlimited. If where we see needs to help with long dated project, long dated initiative, we will issue more bonds to help with those economy. So my key takeaway at MPC is challenges acknowledged by senior leadership at China, remain committed to be accommodative to growing economy. Thirdly, the growing economy, that's the key message front and center from all the statement comes up. So you can turn to the next page. This is where I'm going to save some time to talk about my trip. The only reason I was so excited is because of pandemic, because of all the restrictions, and also I have a very young boy, so it didn't really help in terms of to travel very long out from London. I live in London. And March, John and I together made a trip to China. This is not John's first trip. John went back to China straight away after China reopened. This is my first trip back to China in 40 months, so I was very excited. We literally had about 3.5 days in Beijing, and then I went to Vietnam from there. When we were in Beijing, only 3.5 days, John and I had 21 meetings. It's literally back to back, back to back. But I was very pleased. We met with institutionals, we met with wealth managers, we met with the largest bank, we met with a lot of our partners and clients. Last meeting we went was CSRC. By the way, that's the US SEC equivalent of US Chinese regulator. So my feedback, or at least what I collect from this trip, is quite wide, quite broad. So I was also very keen to literally see things by my own eyes to say what is happening. Though we stay in contact with them on daily basis, it's nothing better than if you see it and witness by yourself in your own eyes. So we arrived in China. And then I'll give you some highlights. I won't tell you everything about it, but probably 2 or 3 key things. One was when I meet with this senior executive, very senior executive, they probably have 2 million ultra high net worth individuals as a serve to their client base. He was literally telling me, saying, Xiaolin, 3 years ago, we would be concerned or we would be very worried, have a big question mark, is will the Chinese policymaker do enough to support the economic recovery, help us to stabilize financial market? 3 years later today, that I am worried our client is not positioned adequately to participate for the potential upside in the financial market. That's actually a great statement that I want to hear, okay? He's helping clients to facing into China. He felt these 3 years, particularly the last 12 to 18 months, in his opinion, that is actually giving them a confidence. The pro-growth policy is here to stay. They would see the light at the end of the tunnel for the things to recover, and they are helping clients to position to the sectors and industries who will participate or will lead the economic recovery, which is very pleased to see. And I also, we literally also want to meet with CSRC along the trip, our last stops in Beijing. on the business day was with CSRC. The very first question we got asked, by the way, the people from CSRC sent over to meet John and I are very senior officials. They face international investors, face international business. The very first question they posed to John and I was, how can we help with investor? How can we help with global investor? From that moment, I know they really want to hear our feedback. This is also me giving credit to this new senior leadership. They speak perfect English. They were engaging with us during the conversation. I was dead honest. I remember when I came back to London, Bloomberg get me on the interview and asked me how open, how honest can you be in those discussions. I told him I was very honest. It's closed door. If you ask me, I'm going to give you the honest answer and honest feedbacks, which I shared with the regulator is we want you to stay communicative with global investor, with any investor, okay? Stay transparent and let us know what is happening, why it is happening, and how we can position our portfolio. We know the intention of anything you introduce in the market. Client doesn't not, we don't not like policies or regulations. We just don't like surprise. They were taking a lot of notes. They were taking very much nodding, acknowledging, and agreeing with what we were saying. And recently, CSRC led the effort to announce these 9 measures in the financial market aiming to regulate the IPO market. They stay very communicative. They were telling the investor why they're doing that, what's the intention, how they want to regulate this market, so on and so forth. I think the leadership is doing what they are aiming to achieve, stay communicative, tell the global investor what you're trying to do, so on and so forth. So my kind of key takeaway from the CSRC, they continue to do, or they will keep on doing the right thing, stay communicative with us, and basically help to provide a stabilized market. They also helping with the national team in China to provide stabilizing funding to put into Chinese capital markets to make sure that, if any really alarming cheap valuations, the national team can come in and buy the Chinese equity ETF. Thus far, they have promised 2 trillion renminbi as the stabilizing fund. Apparently, there's all sorts of data available. The one I read from Goldman was 200 billion has been put in place in terms of purchasing the onshore ETF market. So that is that. And then last one is, and then I move on, okay, for my trip, but you probably heard enough, is we went to Beijing, and last day was Saturday, and John and I was really the only day before we say goodbye to each other, and I moved to Vietnam, and then he went back to US and see other clients. Was we went to this place, you see this picture on the screen is a picture I took from a temple called Lama Temple. It's a very, it's a temple called Heaven. So it was very good, okay? So we want to stop by just to check in. And this is the place, literally, have a limited tourists per hour to enter the temple, okay? If I'm seeing you now in person, I'll ask you to guess how many people we allowed into this temple per hour, but I'll just tell you, and then you tell me if that meets your guess, okay? You give a guess yourself, but I'm going to tell you the number now. It's 5,000 tourists per hour. So every day they limited 40,000. The temple is not big. Okay, it's a small temple in Beijing. It's right in the middle of a marsh. It's not per se a holiday, national holiday whatsoever. John and I walked in, it was thousands of people there. Okay, and John is very tall. For many of you have met John, John is very tall. So I walk in with John. You've never thought I don't have a pocket, so I give him my phone. We walk into this temple together, and I wandered around. And when I turned around, probably about 2 minutes, I lost John. I literally get lost with John. Okay. Is that how crowded that temple is? How much tourists is there in this temple? Just a small temple in Beijing. And John is very tall. I've never thought I would lose that tall person. Funny enough, the reunion after an hour, because everyone needs to get out, and then 5,000 of us get out, and we managed to find each other. This is what I want to tell you, that Chinese tourism are touristy, okay? But probably they just chose the destination more local, more domestic. When I was dining in Beijing, the restaurants is 80–90% full to the level pre-pandemic. There's clearly still room to catch up, but you're clearly seeing people is out a lot more, doing a lot more satisfied kind of to their normal lifestyle, to go around, to traveling. I see a lot more tourists in Beijing and the dining area, so on and so forth. So it was amazing to see onshore, and it's very encouraging to hear the investors' feedback, onshore investors' feedback on how they think about their market onshore, given they are dearly close to Beijing. So enough of my China trip. Let's move on to the next page. this is where my next stop in Asia is Vietnam. So I think a lot of this topic comes up, from all of you at different client meetings. I meet all of you, or Brandon and Jonathan meet you, and we discuss a lot of things. I often get asked, will China losing the edge to Vietnam and so on. So I literally want to go to Vietnam and see it myself. Okay, I was there for nearly a week. It was super hot, I have to say. Okay, it's a very hot city, but I have to say people there are really young, really lovely. Okay, cuisine is amazing. Currency is really cheap. I took a cab from airport to hotel. It cost me 350,000 local currency. I was like, oh my God, what did I spend myself to? And when the hotel paid them and charged me back to my bill, it's literally 11 pounds. So I was like, woof, scared me for a second. But all the seriousness is I visited a couple of company also in Vietnam. I visited Lazard. Lazard is the logistic company that owned by Alibaba that is solely like Amazon in Southeast Asia. Okay, so I visit Lazard. I want to see Samsung. I also want to see a few software company there to see it myself. I have to say, Vietnam really pick up a lot. And when I walk around on the streets and see people finishing work at time of 5, 6 o'clock, the city, Ho Chi Minh City, reminded me China, particularly Shenzhen in 2000. It's probably China 20 years ago, how they would have lived up to so on and so forth. I sincerely think, particularly after I attended the discussion on the panel or the evening dinner at a British consulate in Ho Chi Minh City, we had the formal Ministry of the Developments there. He was literally sharing with us the opportunities and challenges of doing in Vietnam. I think I agree with what he said. Was Vietnam has 97 million people, so the not so committed of financial commitments of in building infrastructure logistic will take Vietnam a few more years to become logistically sound and solid, but they're winning on the cheap labor cost front. And for that reason, he says, Vietnam also don't have a lot of the resources or the raw material, the fabric, so on and so forth to do such. Therefore, Vietnam also import a lot more with China, given the rising of their more of a manufacturing side of the business in the country. So I show you the charts on this page. It's really, this is exports goods from China to Vietnam between 1999 to 2023. You can see the trends was really on the uptrend. So all in all together, I think Vietnam does not present a large-scale threat to China. And also the rising in manufacturing spreads out in Southeast Asia doesn't have to be one win, one lose. It can be a win-win situation, okay? Even China has removed, outsourced a lot of those lower value chain items or lower value chain exports to some Southeast Asia, neighbors, but they are not completely losing out in participating that part of the growth. Look at the export, they have exporting to Vietnam a lot. So hopefully this answers some of your questions. If you have any more questions, feel free to get in touch. If I may go to the next page, please. So this is my checklist. Obviously, this is what we look at CraneShares from top down, bottom up, and from macro and from markets. Obviously, the economic growth in 5%. I think the economic target set at NPC for China to achieve around 5% GDP is conservative. It's very conservative. That's actually factoring a lot of the uncertainties, as this is the biggest election year in history. China is factoring a lot of uncertainties of weakened demand externally from international, so on and so forth. So I think achieving 5% target won't be a challenge, particularly we just had the Q1 data release, a few days ago. It's coming in at 5.3%, slightly above the targets. We got to wait and see how effective all those rich liquidity in the system can get directed down to corporates and households. When that happens, you're going to have more confidence in activity, in economic growth from there going forward. I think a lot of the other items there is very straightforward. We have repeatedly said macro in terms of actual corporate policy and monetary policy will stay accommodative. I literally put the geopolitical risk there on watch. Is a qualitative factor more than a quantitative factor, so it's always going to be a risk there. Investor sentiment, this is where I want to touch. I think now, given what I've witnessed, what I've heard myself, and what I see, as a positioning from global investor as the EPFR data become available as of February, not March, showing that global mandate investors has started a net buying of Chinese equity. I think overall that sentiment is actually improving both onshore and offshore towards investing in China. We see a step forward on the improving side than anything else. So I'll leave things here, and if you show me the next page, please. This is where at the juncture that I want you to hear Jonathan directly. Jonathan and I worked together back to our last job as well. In many ways, Jonathan has the expertise and knowledge in helping clients on global, thematic, and very targeted portfolio allocations. And this is where he can add a lot of value to your investment committee discussions on how you should think about China. What are the catalysts we can consider now for the asset class? Jonathan, off to you.
Xiaolin, thank you. That was very kind. And thanks for reminding me at the beginning that we've known each other for about a decade and a half. What you didn't mention, but I can, as I'm looking at your smiling face on screen, is that over this period of time, you have not aged at all, and I look like I've aged 30 years. So thank you for reminding me of that. But as we're on the topic of decades, I think it is instructive to look at something that's pretty unique and that some have forgotten, myself included. So I was surprised when we ran the numbers. If you go back to 2001, at that time, I was a rookie portfolio manager managing pension money. And the name of the game from 2001 to 2012 was diversification. Diversify globally, add to emerging markets, increase your credit diversification. And it was interesting because if you looked at the US equity market, GFC notwithstanding, and other equity markets, the US was not a leader. It was generally a laggard. And in fact, from 2001 to 2012, emerging markets outperformed the S&P on an annualized basis by 10+%. And with a ferocious consistency. If you looked at any kind of 3-year period within that, which is kind of a reasonable benchmark for time horizon, 99% of the time, emerging markets outperform the S&P. It's incredible if you think about it. But then 2012 comes and everything flips. And for the last, 12 years, the S&P is by far and away the global leader. Diversification is dead. You don't want to diversify internationally. You don't want to diversify into EM. Nothing beats the S&P. And so you have the opposite happen, and the S&P outperforms emerging markets by double digits, over 10% a year. And of course, no one will be surprised to learn that in this period, or in these periods, the dollar had a lot to do with the direction of outperformance. In the early 2000s, the dollar was quite weak and losing about 3% a year on average. And in the last 12 or so years, the dollar's been quite strong, gaining about 3% on average, giving a further boost to US outperformance. So this is really important to understand, because where are we today? Are we in a period where the next 12 years looks like the last 12? Or is it possible that there's going to be a shift in markets and portfolios and in the benefits of diversification that look more akin to the early 2000s? We think we may be entering a period where emerging markets and diversification in general starts to work again. And we'll talk about that a little further. Next slide, please. The other thing I want to point out is about half of emerging markets consist of China. So, Xiaolin talked about allocation, but if you're allocated to emerging markets, the right weighting to China is roughly 50%. 40 to 50 would be another conservative way of looking at it. But this is driven by the fact that China is the world's second largest economy, has the second largest stock and bond market, has meaningful growth targets of 5+%, normally 2x what you would expect to see in developed markets. So China plays a very important role and should play a very important role in portfolios. However, as we look at positioning, it's shocking to see that US and global managers have the largest underweight to China that they've ever had. This occurred sometime in Q1. So think about that. Not only has recent China performance driven down the weight of China in indexes, managers themselves that are active are going a step further and massively underweighting to China. This creates, in a funny way, a coiled spring effect. Because imagine what happens if China starts to outperform US and international markets broadly and even emerging markets. These same managers will experience meaningful underperformance and tracking error to their stated benchmarks, and the benchmarks themselves will start to increase their weighting to China as relative performance improves. So this is a really important point because it indicates that we're at this point in time in market cycles where even small, relatively small outperformance by China can create meaningful rebalancing within portfolios by institutional and professional investors. Next slide, please. And taking it a step further, well, what are some of the classic metrics by which you evaluate companies and stocks in particular? We tend to think about valuation and fundamentals and sentiment as important drivers of how you would pick a market or securities themselves. And what's fascinating is if you take, for example, our China Internet and E-commerce ETF KWEB, it's a flagship strategy. It's available both in the US as well as in UCITS form, so listed on the London Stock Exchange and many others. You could see that comparing KWEB to US Internet, the PE ratio, the valuation is 18 or so versus 30 plus. So a significant discount, almost a 50% discount to US tech. And what's interesting is that the performance of the underlying companies has actually been quite good. We've seen revenue growth since their lows in 2022. And while it's hard to read on the chart, earnings growth is also increasing and meaningfully, buoyed by operating leverage that many of these great technology companies in China have, as well as buybacks, which we'll talk a lot about in a couple of slides from now. So it's a very compelling valuation backdrop in terms of relative cheapness, both to the US, but also to itself. China is at multi-year lows, and some of the relative metrics to its own history are extremely attractive. Let's go to the next slide. Here's a fun fact in illustrating this massive disparity between US companies and Chinese companies. Amazon is a $1.9 trillion market cap firm with $70 billion of cash on hand. You could sell Amazon and buy all 32 companies in KWEB, all of them, and still have $800 billion left over. That's shocking. One Amazon equals 32 leading China internet tech companies plus 800 billion left over. And oh, by the way, those companies have almost $300 billion of cash on hand. Now, many of you are saying, look, there's so many reasons why this is unfair, this, that, and the other, and this is just one way of looking at it. Market cap is a singular dimension. All that is true. So let's look at a couple other things. Next slide. Earnings. KWEB companies have out-earned Amazon by a factor of almost 2x. Historical earnings growth. KWEB companies have had higher revenue growth than Amazon over the last 5 years. And on a forward earnings basis, KWEB companies are expected to have higher earnings growth than Amazon in the coming years. So in almost every way you slice it, cash on hand, earnings, growth rates, historical, future, KWEB companies looked very compelling vis-a-vis Amazon and more broadly US tech. Next slide, please. And because these companies have so much cash on hand, we're getting quarterly updates that are extremely impressive in terms of buyback yield. Now, buyback yield is just the percentage of shares outstanding that a company is buying back over a given 1 year period. So in the US, for context, a good buyback yield is somewhere in the 1 to 3% range. Many companies in the US have buyback yields that are less than 1% or zero because they're not buying back shares. But buybacks are interesting because what they do is they signal to the market that the company feels that their stock is very cheap. And it also removes shares outstanding from the market, which increases earnings per share. If you buy back 10% of your shares, your EPS growth pops by 10% roughly. So what's really fascinating is that a number of the top 10 holdings in KWEB, most of them in fact, are doing buybacks. And in many cases, the buybacks are high single digits, low double digits. So triple the rate that we would expect in the US. Just to put a finer point on this, just last night, JD announced that it had bought back 3% of its outstanding shares just in Q1 of 2024. So we'll have to update this slide to show JD's annualized numbers that are now in the double-digit range. But this is important because buybacks don't get immediately reflected in share price necessarily, but over time, because of the positive effect it has on market confidence as well as EPS growth, it's extremely impactful. Next slide, please. So here's another way of looking at the dynamics between the China market currently and the US market. And there's a style way of looking at it, namely growth versus value. If you're thinking about KWEB, a suitable comparison to KWEB is NASDAQ, because they both have 85 to 90% exposure to growth, the growth style, so a lot of tech for sure. And just looking at various valuation metrics of KWEB to the NASDAQ, you could see that, again, PEs are at a significant discount, almost 50%. Earnings growth on a go-forward basis is almost 2x higher, and therefore the PEG ratio, which is the PE divided by growth, is at a significant discount as well. So there are two ways to interpret this. Either the China market is extraordinarily inexpensive, the US market is extremely overvalued, or, as is usually the case, it's some combination of both. And this relationship is not unique to growth-oriented parts of the US and the China market. It also extends very handily to core equities. So if you look at MSCI China and compare it to the S&P, you see a lot of the same characteristics, maybe not as extreme, just given the Magnificent Seven and the huge run-up that the NASDAQ has seen in the last year and a half. Next slide, please. So despite our extraordinary bullishness and excitement about where China is in the market cycle, the economic decoupling that we're seeing between China and the US. I mean, think about it, some of the things that Xiaolin said about monetary policy, fiscal policy, regulatory policy, everything to promote pragmatic growth, stability, and unlocking the $3 trillion of excess savings that China has sitting on the sidelines in consumer bank accounts. All these steps that the Chinese government is doing is very different than the challenges that the US government is doing and a lot of global governments are doing in trying to fend off inflation and manage interest rate risk and so on. So despite our enthusiasm, we've also heard from clients that they want to have different ways of investing in China. And so we've built a China volatility management suite that gives investors exposure to pure play income strategies using China volatility. And that's our KLIP strategy. It's a covered call strategy that generates meaningful monthly distributed yield of roughly 4%. But we've also more recently, just in February, launched K-Pro and K-Buff. And these are strategies that are designed to provide downside protection with capped upside. So when we launched K-Pro, it was offering a 100% buffer, meaning protection to the downside with over a 23% upside cap over a 2-year period. Those numbers change slightly as performance emerges in the ETF, but that is very attractive. Think about that, getting nearly full downside protection with over 20% upside over a 2-year period. We've also launched a buffered ETF that's called K-Buff, and this provides, at launch it was 10% downside max with over 40% upside, and now it's at about an 88% downside buffer with 38% upside potential over a 2-year period. These are very interesting and are akin to what some of you may be familiar with as structured products. A lot of banks produce structured products that allow you to customize a pattern of return with some protection and upside. So these are very useful tools in building a portfolio if you want to customize a pattern of returns. I'll give you my own personal example. When we first launched these strategies, I bought them 50-50. I put 50% in K-Pro, 50% in K-Buff, and that gave me a max downside of 5%, but gave me upside of 30% potential over the next 2 years. That's a 6-to-1 reward to risk ratio. That's extraordinary in my mind. There's not very much in the marketplace that'll give you a 6-to-1 reward to risk opportunity. And again, the truth is, what's good for K-Pro and K-Buff is also good for KWEB itself. So it's important to note that KWEB, if you believe what we believe in terms of the opportunity, is really the way to maximize return. It's certainly riskier than these other strategies, but if you're a return-seeking investor and you can absorb the risk that exposure provides in your broader portfolio, investing 100% into KWEB is also very appropriate. So on the next slide, because KLIP has been around for over a year, we thought we would just share with you the monthly distributions that we make for KLIP. Keep in mind, the way the strategy works is that we invest in KWEB, we write what are effectively monthly covered calls on KWEB, and they produce somewhere between 3.5% and 5% monthly income. And then at the end of the month, we pay that income out. We don't hold any back. And so this has produced a distribution rate of roughly 50% and has been very well received by investors because that income also cushions the volatility of KWEB. It reduces KWEB volatility by about 35 to 40%. So it's a way to dampen volatility and produce an income profile that's quite attractive. Next slide, please. And then I wanted to finish by talking a little bit about recent performance. And Xiaolin started talking about kind of the quarterly results that we saw across China and other markets. And if you look at just the full quarter, it masks a lot of the very interesting dynamics that are taking place beneath the surface. January, as it turns out, was a very tough month for a lot of the China indexes. And here we're representing China with various Crane ETFs. KBA is a A-share ETF listed on the New York Stock Exchange. Chen is an A-share ETF listed on the London Stock Exchange, available in UCITS. And KWEB is offered in both US and UCITS. And you can see January was tough, high single-digit to low double-digit losses. And that's really on the back of something that is related to these callable bull-bear contracts that are very popular in Hong Kong. You may have heard about these, you may not have, but these are effectively bank-issued strategies that have knockout features, which means that as the market, the Hang Seng market, is breaking through 17,000 and 16,000, etc., there's forced selling within these contracts. And so as the markets were declining, a lot of these callable bull-bear contracts were forced sellers, and exacerbating what was already what would have been a much more shallow decline in China. But look what's happened since. If you go from the start of February, once some of that carnage had taken place, and through mid-April, you could see that China is up double digits. So not only are we seeing mean reversion, we're seeing the start of this recognition that China as an asset class, China as an investment opportunity is attractive. And some of some of the early money, the smart money is starting to get involved. There are also some technicians that are very attracted by the 200-day moving average and some of the bands that are in place around many of our strategies. So we're starting to see early adopters and people coming back into China. And again, continued buyback support, strong fundamentals, very good valuation. And then finally, sentiment. I mean, sentiment is still pretty negative. I feel like the relationship between geopolitically between China and the US and some other countries feels like that Adam Sandler movie, 50 First Dates. I don't know if you've seen this, but in this movie, the characters go on a date, and the female character loses her memory every day. So at the start of every day, he has to remind her why they should be together in a couple and so on. And the reason I say that is because it feels like the news cycle is very up and down. You have very positive developments between China and the US. And then the next week, the next month, it's like all that was forgotten. And now there are negative things, whether it's related to geopolitical conflict, tariffs, or TikTok. My view is that that's to be expected. You're going to have a lot of political saber rattling between the US and China. These are the leading economies in the world. But my view is that there's more bark than bite as it relates to politics. And you have to look beneath the surface at the economic relationship and the strength of the exports and imports, the hundreds of billions of dollars that US companies make in China. Take Apple and Tesla, for example. So there's a lot of very positive economic development that's taking place beneath the surface. But let's be honest, you're going to have a lot of headline news and noise that will drive the very short-term sentiment between or for US and global investors in particular. So we're very optimistic and enthusiastic about what's taking place in China now, supported by policy. And we're pleased to see some of these green shoots in performance. I'll pause there and turn things back to Xiaolin to wrap us up and open us up for Q&A.
Thank you, Jonathan. And exactly, if you have any question, I already seen some question already coming in. So if you have any more questions for Jonathan, for me, for any of us to address, please feel free to send them in. Obviously, I just want to summarize this with everything Jonathan and I have been saying in this quarter is, forget about if it's China. If any market today with such stance in place is pro-growth policy, monetary policies, or physical has been staying accommodative and here to stay, and corporates' earnings, you've seen the numbers are back on their feet and continue to deliver strong earnings quarter over quarter, valuation at alarmingly cheap level, and all the companies that lead in terms of the growth of the economy are initiating share repurchasing program 3-4 times more than their US counterparts has been done historically in terms of the percentage that Jonathan shared as well. And with all of that together, it is underallocated, underweight in global portfolio. Would you consider that is quite an attractive asset class to consider? I would say yes, but obviously we are here to present you all these facts. We see clients are phasing in slowly, gradually. So I just say, these are the things that we observe. We want to give you the factual information we see on these data. And then some of you has asked in that questions is, how do you deal with media narrative? I'll answer that later, but I think it's a great example, great question. I really love that question. So this is everything together with such, if you take a step back to look at this asset class from slightly distance, at the end of the day, long term, this is the second largest economy in the world, which is at a very important crucial stage for its own growth. that is trying to rebalance its economic model from lower chain value of exports, manufacturing exports, to the higher end, namely in the new force or new productive force that China has been repeatedly saying in EV, in clean technology, and then the consumer innovation of technology there as well. That is at the stage of rebalancing its economy to produce a long-term sustainable growth in the long run. Obviously, all these opportunities does present with volatility. That's why we design our solutions that give you the beta exposure, also give you a bit of the protection exposure. You can choose to dial in, dial up, combine them so that it gives you a timely allocation in terms of beta exposure to this particularly asset class. Let's wrap everything for our contents we prepared to share with you. Jonathan, shall we look at the questions together? So a few comes in. That's one, I think, by YF Chen. So please feel free to send us the question by using the button or send to info@CoinShares.com. She literally asking the policy developments happening in China with Western media narratives, so on and so forth. How should we, or what are needed to change, for the audience or for the media to on those narratives? It's a great question. I think when pandemic restriction, October, this is October, was it last year, the year before, when China hosted its Chinese Communist Party Congress, I was asked by a big media, to say, can you stand by to give us an immediate take after the Chinese Communist Party Congress and give us your take on it? It was, it was 12 o'clock. I think it's China time for the report to happen. It was my 7 a.m. in London, so I wake up at 2 a.m. wait for any news comes out. So I gave my feedback to the reporter, everything I said, and then in one of them I said, listen, they didn't mention anything on COVID, so maybe no news is good news. The relaxation may be coming. However, given my experience living in London, when we remove the restriction, the cases spike up, so that may be a bumpy road ahead. And then the afternoon, my quote get published. Xiaolin Chen from KWEB think it will be bumpy road for China ahead. That's it. Come on. Did I say that? Yes, but it's out of context completely. So I think there is a narrative, but I have to say, given all the media exposure, Jonathan, myself, Brandon, and a lot of my colleagues at KWEB get often asked to comment on a lot of development happening in China over these 10, 11 years. I have to say, recently, the sentiments, even from the media, towards to be more balanced. Some of the programs stay up late in the middle of the night to give an update on certain events happening. I have to say, because or contributed from Chinese policymakers' consistency and persistency over the last 13, 14 months of saying, we really pro-growth, this is the policy, we stay accommodative, repeat that. It's just like my comments told to CSRC is keep that very communicative, very consistent and persistent. Market will read into those, market will appreciate those. Those actually can help to change a lot of the sentiments towards China. Jonathan, I know if you have anything to add, or shall we?
I would just say also, be careful of the source. It's kind of like what Xiaolin is pointing out. Media is changing, right? So sometimes you want to have clickbait or get people to look at whatever you're writing or whatever you're saying. And that's why KWEB tries to provide a balanced perspective so that we're not being sensationalist. We're also being realistic about the positives and the negatives, which is why we provide you with these phenomenal dashboards and are very honest. If you looked at some of the things that we presented in 22 when things were tough, we had a lot of our dashboards showing red, not green. So we try to provide a balanced picture. We want people to make money and be successful by investing in China, but it is really frustrating to us because I'll give you an example, right? If China prints a GDP number that's, let's say, 5.1, and the expectation is 5, the market will react to say, oh, China's going into a recession. Like, this is terrible. Think about that, right? For developed economies, right now, a 2 to 3% GDP growth number is phenomenal because they're avoiding recession. But in China, everything is treated as a miss. oh, revenue missed by 1%. Even if earnings growth is up triple digits, we've seen it recently in this earnings season. Nobody talks about the positives. Everything is focused on the negative. So I would encourage, anybody that's trying to understand more about China, obviously tune into us, but get information from different sources so that you're not, being influenced by a lot of the clickbait that's out there.
Great point. Great point. We also got another question coming in from Dan, asking our take on the real estate sector, property sector. His question was, still seems like there's another leg down in the property sector. Do you want to kick off, or you want me to start?
Oh, please. I know you were just there, so I'm sure you got some feedback.
I was so keen to tell this, and I think I said that at a CNBC interview last week, was property sector then, and all the people who still remain on the lines, it will not be the key driver for China's economy going forward, period. Period. It will not return to the stellar period they had in early 2000, even in 2010, that it was really the key sector, so on and so forth. That being said, the home price correction has been stabilized. It's been correct over 10 months. The drop is now more stabilizing, it's more finding a floor on its own by now. And also a lot of those real estate developers is really winning the time to complete all the projects or all the buildings they sold but not finished. So in other words, is trying to avoid any potential social instabilities. In my opinion, all those bad eggs should declare bankruptcy. They're already bankrupt. All the investors onshore knows they're bankrupt. So in those like sector names wise, I think the cleanup need to happen either later this year or early next year. That should happen because they have earned their time to finish the project, the job done. They should move on to be declared done. That's the names. Fundamentally, I still think China has a lot of room to let the real estate sector to continue to grow in some ways. For example, green infrastructure. China, to achieve the carbon goal today, they are at staging 2, which is manage how much we emit. Okay, we're not yet at the staging to say we can start to reduce. It's managed. For instance, smart EV, why EV was so heavily developed in China. And all of that still need a good infrastructure. For instance, power grids. Those old ones are not capable to deliver the new needs in their clean hydrogen, all these technologies, so on and so forth. So I think they can still kick off an infrastructure project, but more in line to deliver their carbon goal in those instances. Do you want to add anything, Johnson?
Well, the only thing I'd remind people of too is longer term, China's only 65, 70% urbanized. So the demand for real estate will continue to grow dramatically. The kind of build out of tier 1, tier 2, tier 3 cities is happening and will continue to happen. But I agree with Xiaolin. They had a 30-year real estate bull market in China, unprecedented. Here in the US, for example, we have real estate cycles that last, 8 to 10 years. So it's not surprising that it was this pretty severe correction. But just keep in mind, China's got a long way to go in terms of real estate demand. And so the supply will be very important and prices will recover, albeit more slowly.
Right, we're going to run over a few minutes. I promise you 5 minutes at the most, because we really have a lot of good questions. Thank you for sending them in. One of them, maybe we just build on from here, is didn't disclose the name, but says, any thoughts on the EV sector in China, particularly NIO, BYD, and Xiaopeng? Oh, it's actually Xavier asked the question. Do you want to start? EV? You know what? It is really an initiative that China chose as part of the plan. Like I said, staging 2. Well, staging 1 declared we want to deal with carbon issue. Staging 2, financially committed, everything committed to deal with how much we can manage to emit. EV is part of the chain of the solution. So obviously these companies are dominating in many ways, and also they built out a really solid infrastructure like NIO. They're changing battery or the battery swap warehouse. It was built 2,400 plus in China. It was amazing. The battery swap is like the electrical vehicle car. You drive in 5 minutes in and out, you get changed to a new battery free. They may charge, I think they should charge. That's a good source of income, but it's free. So it's a lot of things they build is really smart. The interior is very, luxury, but the price is not too much high. For instance, use Tesla as a benchmark. At the end of the day, I think EV market will continue to grow regardless. Someone may argue there's headwinds, so on and so forth. I tell you, BYD. I live in London. BYD already entered the UK market. Okay, many years ago, 3 years ago probably. I seen their shops, near where I live, and they also did a lot of exhibitions in one of the largest shopping mall in London, so on and so forth. They have entered the market. Local consumer can start to order the vehicles from there. We were at Neil's warehouse in Rotterdam, and they have a big, Norway, big presence in Europe. And I saw that, I'm caught up with their general manager here a few weeks ago. They already entered German market. So a lot of these developments of these Chinese EVs that consolidating their market in China, internationalizing their business globally, I believe this will be the trends to continue to go, and they will deal with whatever the rules, regulation required locally for them to still pursue forward. I think that's what I would say. So I say answered you. So the other things I think, Jonathan, might be interesting to look at, maybe given the time, we have a lot of good questions.
I know, amazing.
Please tell us if you need, if I didn't answer your question, we didn't answer your question, send an email to info@crainshares.com. Jonathan and I will answer you personally. Let's take one more question here on renminbi and currency. So this one, also didn't share the name, but say, do you believe in any risk of deflations, especially with weakening renminbi? I think the renminbi movements is a lot associated with dollars. Okay, I have to say, okay, the renminbi's currencies, they set the range, they manage the buffer, they let all the interbanks managing the buffer. I really think a lot of the movement in renminbi obviously is two things. One is the diversion of the monetary policy happened in China and happened in the US, Europe, and so on and so forth, that we are literally, raising interest rates where China is being cutting with. So that's different direction altogether. But now I think you got to really watch carefully where China is. In the past, if we talk about earlier 2000s, a weakened renminbi is good because you're exporting, you want people to buy because it's cheap. Not anymore. China buy also a lot of stuff to import to produce what they needed as an export. So the currency is a balanced one now than one way they preferred. So obviously the weakening and everything in action was partly due to US dollar, partly due to the monetary policy in China, and partly also due to the exports weakened globally in exports from China, if you look at March exports data. The other thing, I think the reason for deflation, China hasn't had a good inflation run for a period of time, for quite a long period of time. But obviously the major basket was food related. Given the logistics getting better in the past, I live in Harbin. My hometown is Harbin in China, is northern. In winter, minus 30, 40 degrees, you don't have fresh veggie. Getting a fresh vegetable from a southern part of China to northern is very expensive. Today, you can get delivered tomorrow. So I think a lot of things has overcome the overall challenge. There may be a reasons of one, commodity veggie are all coming down in China. So inflation was really not picking up that much. Maybe rebalance of their inflation basket. I don't think their inflation basket is as our inflation basket in the UK or in the US as well. The other things is for an emerging country, I do agree with you, inflation is something we got to watch closely. You do want some inflation. You don't want a persistent inflation in the emerging country. Johnson, anything you want to add there?
No, but I wanted to ask your permission to answer one more question because I realize it's kind of the so what question.
Sure, please.
I don't think I covered it, and it relates to the catalysts that might change the sentiment around China versus US tech. And, I didn't talk about this, but yes, China's inexpensive, and what may really get the performance moving and catalyze the outcomes even further. And I can share with you conversations that we've had with a lot of clients. A lot of our clients have said, I'm okay missing the first 20% run in China. They've told us that. They're kind of in wait and see mode. They're on the sidelines. And by the way, we're getting close to that 20% relative move already, just here in April. But what they also said is they can't miss the next 20%. So the thing here is, we know there's a ton of pent-up demand waiting to get invested, and some investors are going to miss the first 10, 20% run in China, and they're okay with it. But we also know that they can't afford to have China outperform the S&P or the NASDAQ or just be up in absolute terms by 30, 40% without cutting those massive underweights that they have right now in portfolios. So we would encourage investors to get ahead of it, at least be benchmark weight, if not slightly overweight, but we recognize that some won't. But once that does happen, and that can be measured in weeks and months, not years, you're going to see really changing dynamics, particularly as US equity markets start to wobble here at all-time highs.
I agree. And thank you for that. And I think we got a lot of questions and I don't want to overrun. I still see about quite a lot of people stay on the line. I do one last one. This is important. Someone asked, how do you respond to clients who doubt about accuracy of Chinese economic data? That's a very valid question 20 years ago, not now anymore. Okay, 20 years ago, you may have very limited piece of the puzzle. You can't even put the puzzle together. Today is very different. Credit is there, from corporate is there, money flow is there, household borrowing is there, the exports is there, PMI is there, all these imports is there, and all these CPI is there, job creation, everything is there. We can do our own math. We will be able to know how do we feel about all these growth happening. I'll give you an example. In Q1, we were asked to stand by when Q1 data comes out. It was 2:30 a.m. of my London time, okay? So they gave a first take on China's GDP. I had a positive feel about it. I sent my script way ahead. So and that's as a proof that I said what I said. I did what I said. Also, is the credit pickup in January, in February, in March from household, from corporates, really telling you something. That's a leading indicator to say people start borrowing money. Then I had a good feeling about the PMIs, numbers, so on and so forth. So I had a hope, also a forecast. Q1 GDP will actually deliver. Okay, and then it proved to be right. I don't have any crystal balls. It's really based on the data is available, is activity is there, are people borrowing money? Do you see the movement, the flow happening in the underlying economy? If the answer is yes, you should have the confidence the data will be XYZ way. So I just say, like Jonathan was saying, expand your channel of getting information about China. Come to us if you have any particular question, particularly subject. There's a few we didn't address today. Unfortunately, we already overrun 10 minutes. We will address you personally. But come to us if any specific topic you have in mind, reach out to us. And also, the data is so rich, available. Do the math ourselves. We'll get our own conclusion. Do we believe that? And today, everything we listed here is really data you can source from Bloomberg, you can source from anywhere, everywhere. And that's why I give you the confidence that these are the data you should seriously looking at it. Anything to add, Jonathan?
I think that's fantastic. Great place.
We really appreciate your time. We overrun, I know, but we cover a lot of good questions and we still have a lot of questions we didn't cover. I apologize for that. And Jonathan and I are looking forward to catch up with you in the next quarter. Okay, see you in 3 months.